Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the market's flight to safety. Wall Street Window's Mike Swanson has been making money where his mouth is. The Corbett Report's James Corbett tells us about a shocking move by Japan's biggest bank. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always nice to be with you, Jim.
Taking a look at the markets this week, what's your feeling? Was it a flight to safety?
Well, the tail end was definitely a flight to safety in just about everything. The week started off a little mixed. U.S. dollar was down for the first few days, and then it got close to the support level we were talking about, the 93 to 93 and a quarter level on the basket. But all week long, it was U.S. Treasuries and gold, which we're seeing the influx of capital. The bond markets, 5 and 10-year bonds in the U.S. at the lowest yields that we've seen this year. And the gold market got up into the 1277 range, the top end of what I had been thinking would be the rally off that $1,200 low. And at this point, I think it's going to be pretty important the next week and a half to see how the markets react, both around the FOMC, the Federal Open Market Committee meeting next week, and then the week after with the Brexit in Britain in terms of how that vote goes. So as we move towards both of those, I think if anything, the FOMC is probably less significant because the probability of an interest rate rise is almost at zero, and even the chances of one in September is definitely in the low percentiles in terms of probability right now. But it's a choppy market. We saw the equity markets have a pretty decent move first part of the week. S&P broke out to new highs, or new recent highs. But you see the transports are failing, and we're starting to see a buildup of the bearish Dow theory type of signal that we saw last spring, a year ago, when the transports were failing to confirm the move that we saw in the industrials. So for all that we are in a seasonably favorable period right now that should last until the early to mid part of July, it could be fairly choppy. And we're looking at this May low that we put in right there on May the 19th, 20th, as being a pretty critical support.
The price of oil over $50 a barrel for a few days during the week, a bit of a correction at the end.
Bit of a correction, closing down just below $49, and it's interesting that the oil rally, it was about 3 or 4 weeks ago, we started to get the first signs that we were getting long in the tooth in this move, and that was still when we were into the mid-40s. Prices pushed up, as I say, maybe to 51 and change, and if anything, looking a lot sort of like the Canadian dollar did, which was overextended on its rise and then had a hard correction. So with the oil market right now, the $47.5, $48.5 range is a pretty critical support. I think if we start to see it move through there, it will be an indication this momentum has been lost, and we'd be looking for numbers down in the low 40s, and that's going to bring out a pretty good correction, which we already started to see in the oil-related stocks, the XLE in U.S., the XEG here in Canada, those ETFs, some pretty good outside reversal moves in the last 48 hours.
How are bonds holding up?
Well, as I say, the bond market doing especially well. Even, when you look at the high yield, JNKs and the HYGs, the good week. Finished the week a little bit on the soft side the last 2 days, but overall, there has still been this demand by investors for higher yield product, and it might be getting a little tired in here, but the trend continues to be buoyant. Would be concerning, though, if the oil starts to break. There's a very tight relationship between those higher yield bonds and the oil market. So breaking that 47.5-ish range in oil, I think you could be looking for some weakness over in the high yield area of the bond market. But in turn, that would be strength for the government side of the bond market.
The U.S. employment picture was horrible. They found out 38,000 jobs created when usually they get 175,000 for a week. Also in Canada, though, a different picture. Nearly 14,000.
We got our 38,000 on the upside, and the dollar had an exceptionally good move early Friday morning on that news, but then it started to give up ground. It closed down about 25 points on the day, and this looks like it might have been the reaction high, the recovery high on the Canadian dollar. And with oil, and we mentioned this a week or two ago, when you have oil making a new high and the Canadian dollar failing to confirm, that has been a pretty good precursor to signs of weakness in the currency. So if you can't match what's going on the commodity side, there's more to the equation. And it's not just the oil market that's been rallying. If we take a look at the agricultural commodities, you look at the GKX index or the DBA, which is the agricultural ETF, those have recovered about 25% off the lows right now. And that's, when we take a look at bear market rallies, the rallies tend to be 20 to 25% off the lows, and the better rallies tend to be around 40%. And at this point, those two indices, DBA and GKX, are up to that 22% level, and I'm getting some short-term overbought signals. Some of my exhaustion work that I do with the indices are kicking up red flags here. So wouldn't be at all surprised to see the agriculturals give up some ground, and that might be part and parcel with the movement in crude oil. And on the other side of the coin, the U.S. dollar index, which seems to have found good support, and we'll see how we move through this FOMC and Brexit news in the next 10 days. But the U.S. dollar, I think, if it has found support here and starts to rise, that is going to be detrimental to the commodity page.
Ross, thanks for being on This Week in Money.
Nice to be with you, Jim.
If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Ross Clark is an investment advisor at CIBC Wood Gundy in Vancouver. Coming up next, Mike Swanson on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome to This Week in Money, Mike.
Oh, it's great to talk with you as always.
How distorted are the numbers that we're seeing from Wall Street right now? I understand one of the practices that a lot of brokerages are doing is putting a lot of money in just a few stocks, and does that distort the whole market?
Well, that's been a big story now for really a year, and it's very significant for people to understand what that means. When you have a bull market, which of course in the United States, the bull market started in 2009. I actually think it's coming to an end, or it's a topping market, but it's been several years. And the key thing is when a bull market starts, typically what you'll see is money come into almost every single stock across the board. The stocks are very depressed on a valuation basis, and many have just been so beaten down it's almost unimaginable, paying huge dividends and just trading at very low price to book value and so forth. So money starts to really just flock to everything, and you can see huge gains off the lows at the start of a bull market. But then as time goes on, you'll see the the huge gains kind of come to an end, and then rotational patterns will start to occur where typically in a new bull market, you can see consumer stocks lead and more kind of safe stocks, so to speak. But towards the end of a bull market, typically everything has been bid up so high that now the people trading no longer really think about valuations at all, and they simply become people chasing whatever seems to be hot. And that case, if you think back to the 1990s, you had the internet stocks, of course, blow off, many of them making no profits, being valued based on page views and whatnot. But in this United States bull cycle, something similar also happened. If you can recall back in 2014, when the price of oil started to falter and fall, there's a big theme on CNBC that, well, now the consumers are going to be able to spend more money from the money that they're saving at the gas pump, and they'll go to restaurants and spend money there. And Jim Cramer was pumping all kinds of restaurant stocks, and they went up pretty good for 5 or 6 months. Now they all turned into duds from where they were a couple years ago. But that was the theme at the time that was real hot. And then there was a bit of a correction into fall 2014, and people after that dropped. They all of a sudden chased biotech stocks, and that became a fad sector that is really significant because most of these biotech companies, besides the giants like Amgen and Biogen, they don't really make any money. Many of them are only developing 1 or 2 drugs. They don't even know if they'll ever work. Some of them are almost borderline on being frauds, but these were the stocks that get bid up. And at the end, they were kind of the last real fad sector in the United States. And then when you get really to the 9th inning of a bull market, what tends to happen is there really are only a few stocks that are acting stronger than the averages in going to new highs and going, up and up and up. So if you think to last year when we were talking about this, in July, there were about 3 dozen stocks in the NASDAQ 100 that were going up to new highs while the rest of the market wasn't. In fact, a lot of stocks actually started to diverge away from the averages that summer and go lower. Apple, for instance, was probably the one that people are most familiar with. But in July last year, it topped out, and it's been a laggard ever since. Well, a lot of people own Apple. It's actually the most owned stock, so people know what happened with it. But the same thing has happened to most stocks in the United States stock market. They're actually performing worse than the averages, and they've been doing that really for over a year now. And again, what this is a sign of is you're very, very late in a bull market. This is actually classic textbook how bull markets end. And what has happened last year, if you can recall, once we got to December or so, you could turn on CNBC and they were talking about the FANG stocks, Facebook, Amazon, Netflix, Google, telling people, well, these are the stocks that are kind of left that you need to buy. They're the ones beating the market. And, a couple years ago there'd be hundreds of stocks like that, but now it's these 4. And now Facebook is still doing well, but Amazon's doing well, but Netflix has been weakening, and so one of the FANGs is kind of not in that category at this time. What's interesting is here we are now with S&P 500 a little bit below the highs of last year. The NASDAQ's still below in a more meaningful way, but what's more noteworthy is that when I last looked, there are only about 6 stocks in the NASDAQ 100 that are on new highs and have that chart pattern where they're just going crazy and going up, whereas a year ago it was about 3 dozen. So this thing of fewer and fewer stocks, doing well and attracting all the money is definitely true. It's a sign that we're in however you want to define it, a topping market or a bear market or whatever, with limited upside. But that reality is masked by the average person who only looks at the market averages and sees, well, the S&P 500 has come back from the lows of January. On CNBC, they're pumped on that and excited, and that's all they really know what's going on, and they don't know what's happening with all the stocks inside of it, and the reality that it's only a few that are really doing well.
Is it true that it would take you right now at their rate of return 350 years to get your money back in your Amazon stock?
It could take a long time if you're thinking of it as getting your money back in the sense that it would take that long for the stock to make the earnings to justify the valuation. That's definitely true. That doesn't mean if you put $10 in the stock this morning or tonight, maybe you'll make a little bit of profit on that. But those are two different subjects. But the thing is, when you do buy something in a high valuation level, you are taking greater and greater risk for the long-term return you're trying to make, or even the next couple months. So the funny thing about the stock market is we have had this rally since January. They formed a double bottom in February. We had a big drop last August and a rebound into November. So these rebounds we've already seen really in the past 12 months, two big rebounds that came after big drops. And the drops scared people, but once the market rebounded, people, for the most part, forgot all about the risks or the scare they had. And you just thought, well, everything is safe, everything is good, and I'm going to be very happy. The reality, though, is the stock market's a tricky thing, because the higher a stock goes up, or the higher the stock market itself goes up, the more risky it actually becomes, because you're buying at a higher price. It's kind of like playing musical chairs when you're a child, and they would play the music, and as long as the music was going, it was fun for everyone. Everyone enjoyed it, but once the music stopped, someone would lose their place in the game, and they would be forced to watch on the sidelines, and then it wasn't so fun anymore. Right now, the music's still playing for most people, but it's getting to the end of that record there, and when it does, it's going to be a tough time for most people who don't adapt to the game, but they don't even realize what game they're really playing, and it's a very risky game. The time to have bought was back in February, not now, and certainly not to double down or go on margin and try to pyramid yourself, which is something people also tend to do because they want more action and more excitement, and that's what they're really in the stock market for. Now, I must say, I wasn't one of the people buying in February, so I wasn't advocating people buy in February. And the funny thing is, there's two things that have happened as a result. One, this makes some people very angry that only trade the United States stock market. They just want to hear picks and be told to buy. So I get negative flack from that. But the funny thing is, I'm making more money than they are, or most people are this year, because I have a different approach, and that is to invest at the start of new bull markets. And we are having these wonderful opportunities to do just that this year. You can forget about the risks of trying to buy highly valued stocks in the U.S. stock market and actually get into stocks and sectors that have extremely low valuation, that are essentially in the same position the U.S. stock market was in 2009. And that is the mining sector. The gold stocks have started a new bull market this year. Now, right now, they're pausing. They had a huge run into May, and they're kind of in a nice pause period that gives people an opportunity to buy, but they still have really low valuations. Some of the stocks may not pause. They just keep going up and up, but that's kind of what happens. The good thing is that there's hundreds of them that trade in the United States and also in the Canadian stock exchanges. So there's all kinds of opportunities to pick out stocks now at good valuation levels. And when you do that, you actually, when you get in early in a bull market, you can get huge gains in the first year. So that's the funny thing is the sad thing about the U.S. stock market is that people have become complacent. It's not necessarily, oh, they're going to lose money or this and that's going to happen. The worst thing is that they're missing out on the mining stocks and commodities in general. We've spoken in the past couple of interviews about the agriculture commodities, and there's an agriculture fund, DBA, that we were talking about a few months ago, and it's gone up like 20%, and that's I think it's going to go up even more than that over the next 12 months. When you get at the start of a move, it's exciting, and then you can think, well, this can last for 2, 3, 5 years. Whatever the U.S. stock market does next week, I really have no idea, but I certainly don't believe it's going to go up and double for 2 to 3, 5 years or really do anything meaningful. There's a report I read the other day from Goldman Sachs, and they're predicting a gain of about 2150 on the S&P 500. So people are risking about a 30% potential loss for a 3 or 4% gain and being excited about it, when if you go into the mining sector space, you could try to double or triple your money or something and risk a lot less for what you're trying to make than you're doing in the U.S. stock market.
You're listening to This Week in Money. I'm Jim Goddard. Our guest is Mike Swanson, editor of WallStreetWindow.com. Mike, I know one of the things you like to do is look at foreign stock markets, Greece, Russia, who really bottomed out a few years ago. Would those be good places for people to take a look at?
Yeah, I definitely think so. I bought the Greek stock market in the past in 2012. That's when the pictures and the images of the riots were taking place. And the funny thing is that stock market about doubled in 6 months from the low. I didn't catch the exact low, but there's an ETF, GREC, that I did buy about 4 weeks after the low, and that was I held it for about 6 months, and it had a really nice payoff there. But I got out of it because the situation there didn't seem to be resolved, and then I'll call it broke out again last year, and the GREC thing crashed again. But now it's been basing out a second time, and it's actually on a valuation basis. If you look at the cyclically adjusted PE ratio, it's pretty much the cheapest stock market in the world. The Russian stock market is also one of the cheapest stock markets in the world. Both of these markets, though, I think they're still kind of in a transition phase before a real big bull market starts in them. A transition phase is when you've had a big bear market, a huge drop, and then you base and go sideways. That gives people time to accumulate, invest, and buy. And typically, in those transition times, it's actually insiders of companies that are buying their shares, or people that really know the country and the sector that are investing in it. I mean, really know it, or almost working in these places, or living in them. And it usually takes a year of a bull market before something really catches on and more people buy it. So I think it's a good early time, but it may not go. These places may not go up immediately, but they could really start a new bull market before the year's over or next year. And I actually kind of think the same thing is pretty much the case of the oil and energy sector, which is really popular with people because they want to get those dividends. I don't think the oil stocks are about to start a new bull market in the sense that they're going to go up month after month after month for now on, but it's possible many of them did actually bottom out in February, and they could be basing and starting that transition phase, but time will tell on them.
Are there any other sectors besides gold and oil you feel will be positive this year?
Well, not particularly. It's kind of funny. Well, I guess I could say bonds, the Treasury bonds. I do think they could get a bid up if we see the stock market falter a little bit, or the economy not grow as much as people expect. In fact, last week we've already seen the TLT ETF, which tracks the 20-year Treasury bond in the United States, make a nice pop up when those unemployment numbers came out on Friday and showed there's just totally dismal job creation in the United States. They were the worst numbers in over a year, and the Fed or the Wall Street experts immediately lowered the odds of a rate hike in June or July to practically nothing, when just a month ago they were all clamoring and claiming the Fed's going to rake it in July and the economy's going to boom and this and that, and all of it turned into a giant hoax. But so I do think, there's something there, but really it's a tricky time for people who just want to buy stuff, because the stock market is, it's gone up for years. It reached these high valuations, and that makes it a tough time for people to buy stocks and make money. In fact, as I was mentioning, so many stocks, such as Apple, have done worse than the market averages, that most people with brokerage accounts in the United States are losing money this year. They're not making as much as the market averages are because of the situation. And it's a phenomenon of the fact that the stock market is in this type of overbought, overvalued situation that makes it very difficult for people. The only way they can really make things easier for themselves, I believe, is to buy into the mining stocks. And the mining stocks right now are the only stock sector I see that's completed the stage 1 basing phase and is in a new bull market. Now, I also like the agriculture commodities, but not the companies like potash or whatnot. I think I'm just watching them for now, and I'm not quite sure what they're going to do, but there's a commodity ETF which I own, DBA, which is doing really well. And these commodities, soft commodities, one by one are just surging. For example, if you take a look at the price of coffee, load it up on a chart so I can tell you exactly, but coffee's gone up from $1.20 a pound to $1.40 a pound in just a couple of days. I mean, that's a huge percent return, and there's an ETF, which I do own, which tracks the price of coffee, that was about $18 3 weeks ago, and it hit almost hit 22 this morning. That's over a 15% return in an ETF in just a week. Stock market people just can't do that. People chasing the S&P 500 or Facebook or Apple or these things, they just can't do that anymore in the market. They could have done that in 2009 or some of the other times after corrections. If they would have bought in February, they could make the big 15% return. But it's over. That was February. Now we're in May. We're at the end of a rally. If you want to make money, you got to get into stuff that's starting a new bull market, not after a rally when people are getting excited and you see these crazy headlines about how everything's okay, and ignore the lack of job creation because the market will never drop. That's basically the argument they make. But they said the same thing in 2007. People believe the stock market would never fall back then, too.
Mike, could you tell us a little bit about wallstreetwindow.com?
Yeah, sure. Thanks for asking. It's a simple financial website. I own it. I run it. What you'll see on there are free blog posts that I make a couple times a week with ideas I have about the direction of the market or individual investments. And, so far this year I've been really focusing on gold, and because I think that's where the money is to be made. So that's what they'll likely see if they go through it now, something about gold. But there's also a free email list. You can get even more specific information on there, and I have a free monthly PDF newsletter too that they can get also.
Mike, thanks for being on This Week in Money.
Thank you. Great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. Coming up, James Corbett on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he has worked and lived since 2004. Welcome back to the show, James.
Thank you for having me back on. Always a pleasure to be here.
They hosted the G7 meeting in Japan, and I asked you what kind of fallout was there. Was there any fallout?
Nothing major. Certainly nothing that's really capturing the imagination of people internationally. And here, I think most of the attention was on the Obama visit and the Hiroshima visit. I don't think there was a lot of attention on what was actually talked about at the conference itself. I saw in the local prefecture where I'm located, one of the headlines that came out of the local meeting, which was a meeting of education ministers of the G7 countries, was something to the effect of G7 education ministers vow to continue providing good education, or something like that. The most banal headline you could possibly imagine. So it doesn't seem like there was anything particularly headline grabbing that came out of this G7 summit.
I know some people were expecting Obama to apologize for Hiroshima. Has Japan ever apologized for Pearl Harbor?
Well, that's a good question. I don't believe they have, and certainly, probably more to the point is, have they ever apologized for their atrocities in China and Korea and Malaysia and other places that they were colonizing in the early part of the 20th century? And the answer to that is, well, kind of. They've done it here and there, but certainly not to the extent that their neighbors would like. So that's what continues to cause some major tensions. And in fact, that was one of the issues surrounding this G7 summit, is that it was taking place at Ise, which is a shrine that is a central shrine to the Japanese Shinto religion, which is associated, at least to some extent, with that old imperial nationalist warmongering Japanese mentality. So there was a bit of political brouhaha about the fact that this was taking place there. And that, I think, is just a sign of the overall rising militarism of Japan in this day and age. And I think the Abe-Obama bond is one that has been forged on the tacit acceptance of a re-rising nationalistic, militaristic Japan.
On to other things. Negative interest rates. How are they working out for Japan right now?
Not very well, in any sense. Of course, we've talked on this program in the past about the moribund Japanese economy that, for some reason or other, continues to not be stimulated by the negative interest rate environment that the Bank of Japan has moved the country into. But it gets even worse, apparently. We've just gotten word from Nikkei, which has an exclusive report from earlier this week, that the largest bank in Japan, Tokyo Mitsubishi UFJ, is going to, or is preparing to, relinquish its role as a primary dealer of Japanese government bonds. And basically what that means is, as a primary dealer, it gets certain benefits. It gets exclusive meetings with the finance ministry and inside information from the BOJ about what's coming, so they get to, trade with advanced knowledge, and it's all above board, of course. But they're going to relinquish that role because in this negative interest rate environment, A, there isn't much activity, no one's buying, and B, it certainly doesn't make sense to actually hold these bonds to maturity because you're guaranteed to lose on the deal. You're going to make less money than what you put in. So it's basically ruined whatever was left of the bond market, which itself for the last several years has been propped up by the Bank of Japan. Now it's going to be even even more so, I think, just a paper tiger that's being completely propped up by BOJ quantitative easing. So we're going to see that trend continue and accelerate, and it's going to be interesting to see if some of the other major primary dealers are going to want to bow out after this move.
I was just going to ask, how are foreign banks that do business in Japan dealing with negative interest rates? What's their reaction?
Well, in fact, actually, a couple of foreign banks that were primary dealers have already dropped out. So this isn't the first one. There was some foreign brokerages that earlier this year decided to bow out. They cited restructuring efforts at home and other reasons like that. But I think the negative interest rate policy has to have something to do with it.
Is there any signs the government might reverse it?
Again, there hasn't been any telegraphing of anything like that, and we would not expect that from Kuroda, who seems to delight in surprising the markets. I think that's part of the BOJ's, I don't know if they're attempting shock therapy or what it is, but of course, let's not forget that just before they went into negative interest rate, literally the week before, they said, we're not going to do negative interest rates. We're not planning on that. And of course, the next week, that's exactly what they did. So I wouldn't expect them to telegraph such a move. But for what it's worth, there has been no indication that they're going to reverse this anytime soon.
Are the Japanese trying to get their money out to a market where they can actually make interest?
That's the plan. I think that's obviously part of what this whole idea is about, is trying to get this money out into the economy and get people spending. And the idea, of course, is some kind of trickle up effect, where people are going to take their money out of the JGBs, where of course the Japanese citizens have been stalwart investors, famous investors for a very long time, and try to get it into the economy by putting it in the stock market. And while, of course, the stock market has levitated since the BOJ began its operation several years ago, there still is not a lot of economic activity that's taking place as a result of that. So we have seen the phenomenon of the famously diligent savers of Japan being even more diligent in their saving and spending even less. And that has only been exacerbated by a rise in the consumption tax from 5% to 8% that took place a couple of years ago. And the planned rise early next year from 8% to 10% is likely to have an even more stultifying effect on the economy if the government of Japan does go ahead with it. So yes, people are taking their money out of the bonds, but they're not putting it into the economy. A lot of people are literally putting it into the closet.
And are they putting a run on home safes? We heard that. I thought it was kind of an urban myth. Is it true?
I certainly haven't seen any real evidence of that in my neck of the woods. I have been around to a few of the stores, and there has been no problem with stock here. There may have been some problems at some stores in Tokyo. I think that's a bit overblown because, for the most part, I think Japanese citizens are already well stocked with that. They actually have a word for closet savings, wardrobe savings. It's basically the English translation. And that's a phenomenon that's been around for a very long time. The old-timers here remember the post-war years and the instability of the banking system and how it served their best interest to keep a large amount of cash at home in a safe. So I think a lot of people who want a safe already have one here. Well,
I know in Canada and the U.S. with grandparents who grew up in the dirty 30s, occasionally they'll go and tear down the house and find literally hundreds of thousands, if not millions of dollars stuffed in the wall. So people who grew up in certain eras where you couldn't trust the banks never did grow up trusting them.
Yes. Well, there you go. Maybe people should spring for that renovation that they've been planning to do. Maybe it'll pay for itself.
We're speaking with the Corbett Report's James Corbett, who is speaking to us from Japan. James, what's the latest word from China? We keep hearing their exports were down, their imports were down the last couple of months. Can we believe any of the statistics that come out of China now?
Well, I'm not sure we ever could really rely on the statistics that come out of China, but some of the data that we have coming out certainly is not. It does not look good. And one that I think is particularly interesting that came out recently is that Chinese crude imports look like they are falling at the moment, which is again interesting because specifically because the oil price, the crude price, has just doubled off its February low and just topped $51. It's hovering around that mark at the moment. Despite the fact that production has increased to its highest level since January, it seems that overall crude supplies have fallen for the third month in a row. So figure that one out. But anyway, crude prices are back over 51, and yet Chinese crude imports are declining, and they're not expected to increase substantially this year. So that, I think, is an interesting sign, and of course that's one of the real underlying signs that we would look at in terms of the real drivers of the Chinese economy. We would be looking at such things as oil imports. Because obviously, as the world's biggest oil consumer, that's going to be one of the drivers in global markets generally, and of course that also reflects on manufacturing activity generally in China.
Adidas apparently has shut down all their plants in China and is moving their production back to Germany, where robots will be making the running shoes. I hear anywhere from 100,000 to 1 million jobs in China could be lost.
That's exactly right, and I think China is about to start experiencing what much of the developed world has experienced over the past couple of decades, the outsourcing. But this time, as you say, it's not outsourcing to cheaper labor somewhere else in the world, it's outsourcing to robots. Welcome to the new normal, and of course this was exactly what was discussed at Davos earlier this year. They had a special session on the rise of the robots and the robotic economy. And lo and behold, wouldn't you know it, the Bilderberg Group is meeting this weekend in Dresden, Germany. And if you go to bilderbergmeetings.org, the official website of the Bilderberg Group, one of the things on the agenda this time is the precariat and the middle class. And for those of you who don't know what precariat is, think the word precarious combined with the word proletariat. The idea is it's workers that are not fully employed, they're temporary or part-time, they're in the gray market, they're taking cash under the table to try to make ends meet. And this is a growing phenomenon in the developed world, and perhaps potentially in the economic workhorse of the last couple of decades, China, where more and more workers are being displaced by robotics and or cheaper labor. So this is obviously something that's captured the attention of a lot of people and is going to be the primary concern moving forward as we move into a truly post-industrial global economy where industrial manufacture does take place more and more robotically and through automatic processes. What does that do to literally over in the entire world picture, billions of people around the world who would otherwise be employed in manual labor? And I don't think there is a solution to that at this point.
Right. And who's going to buy the products if everybody's laid off?
Very good question. And of course, one of the ways that people have been thinking about grappling with this question is the idea of a basic income. So people might know that Switzerland just had a referendum on the idea of providing a basic universal income, every single person in Switzerland receiving a certain monthly minimum salary. And that was voted down overwhelmingly by Switzerland. But I think that's an idea that is catching on in a lot more places, and we're probably going to see floated. And of course, that was, I think, at least part of what the Bernie Sanders phenomenon in the United States over the last few months was. More and more people, more and more concerned about their future and the future of the economy overall, turning to those types of solutions from government to try to make everything better.
Did you hear anything about the visiting Chinese minister who chewed out a Canadian reporter for asking about China's human rights record? And Stéphane Dion, the Canadian Foreign Affairs Minister, said nothing about that. And that happened here in Canada.
I didn't hear about that, but it doesn't surprise me in the least. And that's, I think, the way that China tends to conduct its diplomatic affairs. There was a story recently about President Xi's visit to Britain. And apparently there was a lot of negotiations that went on before that visit in terms of the type of reception that he was going to receive and from what members of the government were going to be there, and all of that. All of those details were very, very carefully negotiated, and in ways that the negotiators for the British government described as just plain rude. It seems that this is the way that China conducts itself on the global stage. They do not have any room for what we would consider diplomatic formalities, which may be refreshing in a way. I mean, it's better to have all the cards on the table and at least know where someone stands, but it certainly makes for some uncomfortable moments.
Any updates on Fukushima?
Fukushima is, well, exactly what it's been for the last few years, which is robots being sent in to try to find out where the cores are lying and dying. The ice wall that they've constructed to try to stop the groundwater flowing through the site is not impermeable as they had advertised. The people who have been displaced by this tragedy continue to be displaced and are suing TEPCO and the government for failing to provide what they said they were going to provide them. Unfortunately, again, it's just a colossal mess. But of course, in the lead up to the Tokyo Olympics, everything has to be the facade has to be kept on it. So I think until 2020, they're going to try their best to keep their plugging all these leaks, literally and figuratively, and hope that the international media doesn't look at it too closely. But unfortunately, we've seen a significant clampdown on the Japanese media in the last few years, and we've had more and more big-name reporters over here losing their positions with major networks for simply voicing things that are uncomfortable to the Japanese government. And the word is that this isn't coming directly from the government. The government isn't forcing these companies to fire these people, but that these companies can read the atmosphere, as they say in Japanese, and understand that these people have to be let go. So it looks like the Japanese media is increasingly abdicating from their job of even attempting to inform the public of what's going on. So I think there needs to be more international attention on these issues, and hopefully in the run-up to the Olympics, there will be more of an international spotlight so that we can get some actual reporting being done on these issues.
Does the government in Japan run a lot of commercials promoting government services or promoting the government in several ways? Because in that way, they keep the media beholden to them.
Yes. Yes. I mean, there's the advertising dollars. Although I think that they do more direct marketing and PR campaigns. And right now, I think one of the big pushes is for a new system that is a bit controversial, even in Japan, which usually tends to accept everything the government does. It's called the My Number system, and basically there was a big scandal a few years ago with the government losing the data on a number of people's pensions. And so in order to make sure that doesn't happen, they've started a new system where the government assigns each individual a number, which they then have to use in every interaction with the government. And they're starting to roll it out as a card that you can show and you can use at various businesses in order to get discounts on taxes, which of course means that the government will be able to monitor your purchases. And they're starting to roll this out. So there's a big PR campaign that's going on for that right now, and it's becoming it's pretty controversial here.
Well, in Canada, of course, we have to use our social insurance numbers for things that number was never designed for, but they ask for it, and if you want that loan, you have to give it.
It's, yes, and unfortunately, it's like everything else. People will live under the amount of tyranny they are willing to live under.
Thanks, James, for being on This Week in Money. My guest has been James Corbett, editor of thecorbettreport.com. He was speaking to us from Japan. That wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mike Swanson, and James Corbett, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.